Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I want to do is talk about something that has been all over the news lately, and that is what is happening with interest rates in the market and how is that going to affect the economy as a whole going forward. Now, if you guys are following the news, the Fed is actually going to be meeting this week to discuss what they want to do as far as their target federal funds rate is concerned, which will ultimately affect what interest rate the banks will offer to the general populace as far as loans are concerned. So in today's video, I'm going to explain what exactly raising interest rates does as far as your purchasing power is concerned, and then explain what's going to happen, in my opinion, over the next 6 months or so, and how we're going to be able to navigate those waters as they start coming our way. Now, before we dive into this video, I'd greatly appreciate it if you could like and subscribe to this channel. It really helps with the YouTube algorithm and ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now you've done that, go ahead and like and subscribe below. Let's go ahead and dive into this episode. All right, so if you've been following the news, you probably know that the Fed has been contemplating what it wants to do as far as interest rates are concerned. Over the course of the last year, there have been 4 interest rate hikes, and this most recent meeting, they're projecting that there's going to be another 75 basis points to 100 basis point hike. The reason why the Fed is doing this is they're attempting to quell inflation. The numbers that they received from the previous month, for the year-over-year numbers, was not where they hoped it would be. Therefore, they're trying to take a more aggressive stance to try to quell inflation, which could effectively slow the economy down even more. Now, the reason why raising interest rates from the bank level affects the real estate industry is for a few reasons, and we're going to go into this, explain what happens effectively in this video. So the reason why raising interest rates affects real estate values is because it increases the monthly payment that people have to pay on a monthly basis. So let's just take a scenario so you can see exactly what I mean by this. Let's imagine that you're looking to purchase a $1 million building. You have $200,000 as a down payment, and you are approaching banks to be able to secure a loan to acquire the building. Now, just about let's say earlier this year, interest rates were hovering in that 4 to 4.5% range that banks were offering you. Now you're probably looking closer to 6 and 6.5%. So let's say that you were able to secure a loan today for 6.5% loan. Essentially what that means is that if you put a $200,000 down payment down, and let's assume that you have a conventional commercial loan, which is a 20-year amortization period with a 5-year fixed rate, essentially what you would expect as far as a mortgage payment is concerned, not including taxes and insurance, your mortgage payment would be looking about $5,965 per month. Now, if you were to take that exact same building and you were to have bought it, just 7 or 8 months ago, and the interest rate was 4.5%, your monthly mortgage payment with everything else being equal would have been about $5,061. So that's over $900 a month more that you have to pay to be able to service that debt. As far as purchasing power is concerned, typically what banks like to do is they like to see that you are able to cover a certain debt service. So as the monthly payment that you make increases, they want to see the income of that property also increase to cover whatever the percentage debt service that they're looking at. And usually it's 1.25 to maybe 1.5, depending on how stable the asset is. But let's say that it's, essentially they have to see the value drop in order to make sure that you're still able to cover whatever the debt service requirements are for that loan. So as far as purchasing power is concerned, if you look at a 2% interest rate difference when it comes to purchasing power, it actually ends up being about over $120,000 reduction in purchasing power. So instead of you being able to afford $1 million building, let's say that the building was $1 million and you purchased it at the beginning of this year, you'd be able to afford it $1 million. If all things remained equal and there was only just a 2% shift in the interest rate, you could only afford a building that was $878,000 and change. So almost $122,000 reduction in purchasing power, which would mean that you would either have to come to the table with more of a down payment, or the price of that asset would have to come down. Now, what's going to happen over the next 6 months or so is that seller pricing or expectations are still kind of out of whack, considering what is happening in the broader economy. So over the course of the next 6 months, I think that we're going to start seeing sellers realize that they're not going to be able to get the premium prices that they were getting just 6 to 12 months ago. So pricing is going to start coming down a little bit. Along with that, the broader market as a whole is experiencing a slowdown. A lot of employers are starting to lay off employees, or at least have a plan to do so. And so I think we'll see a broader slowdown of the economy over the next 6 months. And then the beginning of this year, I think the Fed is going to achieve whatever their goal is, which in this case is reducing inflation and working with the unemployment numbers. And at some point this coming year, the unemployment numbers are going to be a little bit out of what their expectations are. Therefore, they're going to ease up on their constrictive policy, thus hopefully trying to reduce interest rates a little bit more, thus stimulating the economy to be able to get back on track. So, my expectations over the next 6 months is we're going to see a tightening of the economy, continued tightening of the economy. We're likely going to go into a slowdown period. And then at the beginning of this coming year, Q1 or Q2 of 2023, I think the Fed is going to release its constrictive policy and try to get interest rates a little bit lower so that we can see a little bit more stimulus when it comes to the economy as a whole. So hopefully you gain some value from this video. Hopefully this video, now you understand how interest rates can affect the monthly payment and ultimately the purchasing power that you can achieve as a buyer. I hope you gained some value from this video. If you did, please like and subscribe. If you're looking to buy assets in this economy, it can be a little bit tricky. That's why you need someone like myself who's an expert in the commercial real estate landscape. If you want to and you're looking at assets in the Louisville metro area, feel free to reach out to me. My number is 502-536-7315, or you can reach me via email at Raphael@CresantiGroup.com. Thanks to everyone so much for the support. We greatly appreciate it, and we'll see you all next time.